as we sort of, start to report on these Friday markets, remember, the week ended last Friday was spectacular. So that's the backdrop that we've got to see what happened this week in. So 24,600 on the Nifty, 24,630 on the Nifty. It's about 0.1% higher. The Nifty Bank is up about 0.9. Nothing. It's basically just about holding on with very, very, very small green change. 1,140 stocks are higher. It was very early to look at it, but for what it's worth. Mid-cap index is up 0.1. Small-cap index also will come up on your screen. And it'll give you a sense. Again, nothing. 2-point change. It's almost as good as unchanged this morning. Heat map on the Nifty, and then we'll get down to stocks. So it's largely in the green, so about some 7-8 names in the red, but bulk of it starting in the green this morning. Surabhi.
I would say Honasa, very well spotted by Mangalam, because indeed, look at the stock, 9% higher. It seems that it's been an absolutely bombed out stock. So perhaps the market saying that is this, a sign of things turning? That's definitely catching the eye, probably the stock of the morning. But let's talk about the Nifty now. Nifty is very, very quiet. The newsmakers here on earnings. ITC is also up, like Abneesh was telling us. Even here, the market's taking a view that the worst of this palm oil inflation is probably behind, so the FMCG business should pick up. And cigarettes is holding steady, so 1% up on ITC. Sun Pharma is a disappointment. US business lower. Specialty business revenues lower than expected. Cautious commentary talking about even the revenue guidance for FY26 is lower than what they typically put out for previous years. Sun Pharma is a result casualty. Reddy's is actually lower. Cipla is too. So all of pharma is starting lower. Other than that, Mahindra and Mahindra, ONGC, ICICI Bank, these are the other stocks on the lower side. Maruti Suzuki also on the lower end of the screen. So let's see what's working. Grasim is responding well after the fourth quarter print, 2% higher over there. ITC I've mentioned. Trent and BEL, both of these stocks, by the way, make an entry into the Sensex, remember. They're up and about today, 1.5% to about 1% up on these names. Eternal, Adani Ports, Infosys, those are the kind of names. The Bank Nifty is absolutely undecided. SBI is on the higher side. ICICI is negative. And HDFC Bank is also completely flat, not getting any directional cues. Reliance, your big names like Reliance, about 0.25% up. TCS, it's absolutely, indecision is pretty much the story today. Nigel, but Sun Pharma, from the large cap space, Sun Pharma is still down 4%.
Well, that's right. And the reason that Grasim is up is because the street seems to be saying, okay, the VSF business, which is the fiber business and the chemicals business, is not doing too well. But at least the losses in the new business, which is the paints, as well as the B2B e-commerce business, out there the losses have come down from around 350 crores to around 315 crores. So they seem to be liking that. But otherwise, plenty of stocks actually from the broader markets that are moving around. Power Mech, good set of numbers. Stock is flying away. Just pull up the intraday chart out there. The stock is doing very, very well. HPL Electric, another stock that's bursting away actually. The sales have come in higher by close to around 15%, and there's strong margin expansion. So big move is what we're seeing out there. Centum Electronics, that's another one. I think that's up close to around, 12-13% or thereabouts. So big move out there. A few stocks actually are building on to gains that we saw yesterday as well. So you have Emcure Pharma, stock is now up close to 10%. You have Cosmo First, that one as well is up and about in today's trading session. And remember, these stocks, they did well even towards the end of yesterday's trading session. So solid move is what we're seeing on a couple of these names. Pull out Reliance Infra as well. I think they had organized, they had announced a tie-up with one of the leading companies globally. And that one, in fact, was moving yesterday as well with high volumes. For the time being, more or less flattish as we speak. So, flattish start with a mild negative bias in the broader markets, guys.
Absolutely. 1,300 stocks are lower and about 800 stocks are higher at this point in time. Vari Energy is down 6%. It's the number one volume-led sort of loser on the NSE right now. So 28-24 on Vari. Look at the volumes. Over 500,000 shares already traded. BSE has undergone a corporate event, I think, right? So 23.53 on BSE. That's Bombay Stock Exchange. There you go. So that is Bombay Stock Exchange. Sun Pharma is down 4.5%. I'm not sure if there is any news flow here.
Yeah, Sun Pharma is on earnings. Earnings being very patchy, especially the US business, the global specialty business, all of it has been below expectations.
So 5% lower here on Sun Pharma. Premier Explosives, 10%. I think we highlighted that, but it basically has had a one-way kind of a move. and from 350, in about 10 days, it went up to about, almost $600. So 550 on that one. Coming off a little bit. Container Corporation, you'll hear from the management, is down about 2.5%, 2.6%. GMR Airport, again, numbers 2.5% lower. This Premier Energy, 3% as a solar company, 3% down, 1,052. Deepak Fertilizer, you just heard from the management, is down about 2%, 1,335, and so on and so forth. So, but there's more, but volumes are kind of lacking beyond that. On the upside, I think like yesterday, the number one volume-led gainer is Garden Reach Shipbuilders. Garden Reach is up another 3.5% after yesterday's near 12% move that we saw. So 28.65 on Garden Reach is what you've got going. It's an all-time high on that one. Power Mesh, I don't know if you highlighted.
Yes.
11% on that one. Honasa, I think we did highlight 12%. Trent is another one. JBM Auto is up about 6%. HPL Electric is up 14%. It's got large volume, so 553. And Cosmo First is another one. Cosmo First was up 20%, limit up by close yesterday. It's a bombed out name, but this morning after yesterday's 20, it's up another 12%. That also reported numbers recently, 2-3 days back. So, that's again coming up very, very sharply. So that's, some of what is moving as far as the market open is concerned. Mahesh Patil is now with us. He's CIO, Aditya Birla Sun Life Asset Management Company, with what he's making of things. Mahesh, thank you very much for your time. Good to have you here. Before we get to markets, let's just address the one situation, which is with regards to IndusInd. As a fund manager, Mahesh, what's your sense? How do you think about this, basically? I'm not asking for a view on IndusInd per se, but do you think after what it has gone through, someone credible at the top will be able to quickly, correct things and get the bank back on growth trajectory as many are hoping to, or this is now going to be more prolonged? Just your thinking on a situation like this.
Yeah, good morning, Prashant. So I think in the banks, I think the most important thing is the two important things. One is on the asset quality side, okay, which is of paramount important, and second is in terms of the solvency. So if you look at it in a bank, okay, it could have some issues on the asset quality side. It could be temporary, it could be cyclical in nature. And as long as the bank's balance sheet is decent enough, the capital adequacy ratio, in spite of taking the losses, okay, which needs to be taken, is good enough. I think there is, obviously the stock would react, okay, to this thing. But finally, I think there is no really run on the deposits. That's another important thing, okay, which needs to be looked at. Retail depositors, what is the confidence? As long as the overall capital adequacy is still fine after taking over the losses, and the deposit side, okay, they're able to hold on depositors. I think if there is a change in management and leadership, okay, that becomes again for investors to look at it at afresh and see what the new leadership has in store in terms of taking the bank, okay, to the next level. What are their plans in terms of stabilizing, first in terms of the asset quality issues, but also more in terms of the growth path, which are the areas they would try to look at, and what will drive the ROAs of the bank to a reasonable level. I think these are the factors, I think, which one would look at, especially whenever a bank or any of the financial services company goes through a kind of a crisis situation.
Mm-hmm. Absolutely. And let's see what finally comes out of it and how quickly they can get the house back in order. Mahesh, morning. Great to have you on the show. So I want to talk to you about the one sector, actually the only sector that's managed to stand out in the last 2 odd weeks, and that's defense. And therefore also, even I was looking at the tally for this week. Actually, defense is the only sector, the Nifty Defense Index is the only one that's up about 1 to 2%. Otherwise, the market's not finding too many legs to run on. Is that a concern on the overall scheme of things? The fact that this up move beyond 24,000 is becoming narrower and narrower. And beyond defense itself, what would your advice be, given the way the stocks have already run up now? Is it, is it becoming a little too hot to handle, perhaps?
Yeah, so if you look at the defense sector a year back, okay, or prior to that, we saw a huge amount of rally in the sector in anticipation of, good order inflow coming into the sector, and there was a focus on the government in terms of sourcing more from domestically, which led to the initial leg of rally, and the stocks really went very high, valuation zoomed, and then we've seen a correction in the last 9 months. Since June, July, we've seen a correction in defense stocks and also PSU stocks in general. And post that, I think we've seen again, if you look at PSU as a basket, right, because most of the defense stocks are in the PSU basket. PSUs are also started to now kind of do well. In some of the cases, the valuations were looking good. But defense in particular has seen a new lease of life again, coming back on the recent conflict, what we saw between India and Pakistan, but also kind of realizing that India needs to secure its defense resources, okay, and looking at the geopolitical risk, there is a feeling that allocation to defense, okay, which has been kind of over a period of time, we see as a percentage of GDP, it is still fairly low. That could potentially see an increase in the subsequent budgets. But near term, I think clearly there is emergency procurement, okay, which is likely to be there, which can mean that you could see order inflows for a few companies, which could buoy them up. So I think.
But are the valuations? I mean, we understand that there's perhaps still significant ordering potential, but the valuations, Mahesh, what do you think of that?
So I think valuations again have been the same, but as long as again it boils down to each company in terms of the order pipeline. If I think sometimes we see in defense there can be lumpy. So I think going back only from a short-term perspective in terms of the emergency procurement, I think that could be a misleading. But companies structurally which have got a long runway and have got larger projects or strategic projects, okay, which can see continuous investments. I think in those companies, I think the multiples could probably be better than what it was in the last, say, 1 year or so, because the visibility there is now better. But I would say that stock specific, I think it has to be looked into it. And while when there is a broad macro theme, everything moves up. But I think there is a credible story, I think, which is there from at least from a ordering side and a more long-term sustainability in the sector.
Okay, all right. Hi, Mahesh. Good morning. Good to see you in. What about the entire renewable energy space? How interested are you out there? You know, because there's plenty of uncertainty. It was a fancied sector just around 18 to 24 months ago. And now suddenly some of these stocks, they seem to be out of favor. And you have some unfavorable news every now and then. Waaree, for example, overnight what's happened with regard to the passing of the bill in the United States. That one's pulled back, though the numbers and the outlook that the company is giving is very, very strong. So from this pack, what do you like?
So the renewable space, one is the utilities or the power producers. I think those are the companies where their valuations had moved up early. I think we have seen a correction over there. I think that's the space which looks now more reasonable in that sense. The equipment guys, the suppliers, whether it is the suppliers of the panels or the cells, they have seen a large improvement in the order book, but more importantly in the margins because of the, mainly the export orders and some amount of demand supply mismatch which was there. I think our concern there has been that while the near-term outlook is good, profitability is very, very strong, there is a lot of capacity which is coming up in this sector, right? Because of whenever you see large margins and good order, you see more players coming up. So in the next couple of years, you could see more capacity coming in the space. And also some of the tariff barriers, okay, which have been put on in China and the US is providing this opportunity to make supernormal profits. We think that could be at risk. So I think in these sectors, especially the equipment guys, we are a bit worried because there could be pressure on margins, okay, because these high margins and these high ROC seem to be unsustainable at this point in time.
Okay, so some caution there perhaps on some of the renewable energy stocks. Got that, Mahesh. Thank you very much. Good conversation as always. You have a good rest of the day and we look forward to connecting again soon. Thank you very much. Well, that's a view from Aditya Birla Sun Life AMC. Markets actually doing quite well, cruising along right now. 100 points higher. Nifty is up about 0.5%. Mid-cap index also up about 0.3%. So it's turning out to be a good Friday so far. Let's keep it with the corporate conversations then. The next company on our radar is Metro Brands. Now, the company reported a healthy revenue growth for the fourth quarter. EBITDA has also improved quite a bit. Let's talk about these trends and the outlook with Mr. Nissan Joseph, Chief Executive Officer at Metro Brands. Mr. Joseph, thank you very much for joining in. So really a good quarter. I think you've got 10% revenue growth. There's a significant margin improvement. Margin is up to over 30%, 30.7% EBITDA margin. So let's start by understanding the broad demand structure and trends, because while the fourth quarter has been looking good, if I look at the year as a whole, FY25, I mean, you had guided as much as 12 to 15% growth. Ultimately, the revenue growth was around, I think, 6-7%. How do you gauge demand sentiment, the mind of the consumer right now? And what do you see ahead in FY26? Is it, how will volumes do? Or will you have to eke out revenue growth with some pricing uptick? What's the sense?
Well, Surabhi, good morning, and thank you for having me. I think we were very pleased to see the upturn continue through Q4 of this year. You're right. When you look at the whole year consolidated, it's been a challenging year. We had a lot of absent wedding dates going back to Q1, Q2 that really set us back a little bit. We also had heat waves. We had the election distraction. So there were some headwinds to overcome through the first part of the year. The good news is on the second part of the year, we were able to recover quite well. As you mentioned, we were up 6% on a consolidated basis by the end of the year. But more importantly, I think what we've shown is our ability to have great financial discipline through the year. Though it was a tough year, as you know, that we posted some very good growth that exceeded our revenue growth in EBITDA that exceeded our revenue growth. And, we came in at the 30% range. We always guided that we would be at the 30% range. While the overall top line growth wasn't what we wanted, I think the recovery was good and we're headed back.
But what now, sir? The question is, what now? You've done 10% revenue growth in the fourth quarter. Do you think you'll build on that in Q1, Q2? What's the kind of top-line expansion we should expect? If you can't give us visibility for the whole year, maybe for the first half, but essentially, is it going to be more volume-led or is it going to be pricing-led?
Well, I think it's going to be both a little bit. We're not raising prices significantly. So any growth you see is actually coming from volume growth in the business. And we're pretty pleased as to how that's trending. We remain committed that we'd get back to the 15% growth rate on an annualized CAGR basis. So I think we have all the indications that we should be headed to that direction. You don't always recover and jump right up to that number. But as you can tell, the indicators the last 2 quarters have been very positive.
Okay, all right. Hi, sir. Morning. Good to see you, Ben. So at least a double-digit growth is what we can work with, right?
I think the indications are all in place, Nigel, that we should be headed in that direction.
Okay.
But more importantly, I think the other numbers that are important to us is the EBITDA and the profit, which we're starting to trend back at the 15% mark, which is we guide to the mid-teens on PAT. And then, of course, the EBITDA, we guide to about the 30% range. And all those metrics are coming in line.
Okay. PAT margins at mid-teens, EBITDA margins at 30%. Got that. Give us a few more details then. What kind of store additions will you be looking at for this year? And if you could help us out with some commentary on e-commerce. That seems to be plateauing a little bit. I think it contributes close to 10-11% of your total mix. Where is that headed?
Yeah, so just talking about store growth, I think we continue to be open and aggressive on opening the right stores at the right profitability. We're not going to open stores for the sake of hitting a number. We're going to open stores as and when they make sense for our portfolio of different brands that we have. Our e-commerce business continues to do well. However, as we all know, you can drive a lot of growth in e-commerce if you want to be discount-led, which we don't want to be discount-led on e-commerce. For the year, e-commerce outpaced our regular growth. We were up 20% in our e-commerce business. So that remains healthy for us, and we like it because it's at a healthy pace that comes where it's brand enhancing, without destroying any brand salience at the same time, is a profitable business for us. So it's one of those balances that you have to do as you want to grow the e-commerce business. You have to decide where you want to lie with that e-commerce machine. And also, we've started exploring quick commerce, and like what all the press has been reading, we find it to be very polar in terms of to the big cities and not as much in the smaller cities. So we continue to explore that as well.
Mr. Joseph, hi. Good morning. So online is about 8%. That channel is about 8% for you?
It's a little north of 10% for us.
Okay, a little north of 10%. Now, in the past, we've spoken about premiumization, right, across the board. Is that happening? Because if I look at, price-wise sales mix on a quarter-on-quarter basis, maybe quarter-on-quarter is just too it's kind of, it's a little, the data is jerky, but over 3,000 rupee products is about 54% of your sales mix. It was 56% the last year. It's broadly been between 52 and 54 odd percent or so. Could you give us some idea about this, how this is likely to trend up?
Sure. We continue to see the premiumization trend, but what you're seeing, and you rightly pointed out, Prashant, is the fact that Q4 is our end of season sale quarter, right? And that's when we use that period of time to clean out any old goods that we have, end of season lines, and that typically mutes your ASPs, right? So what you're seeing, that 2% delta, is really more of a reflection of the business and the cyclical nature of the business, as opposed to anything that's showing a premiumization trend fading off.
Mr. Joseph, can you tell us a little more about the Foot Locker expansion this year? What are you expecting from some of these additions? Fila as well. When does Fila break even? How much will it add to your top line? Some sense from these brands.
Great. So Surbhi, let me take that one at a time. When you talk about Foot Locker, I must be honest and say that the BIS rules that came in has been a little bit of a deceleration of our growth. We would love to grow more Foot Locker stores, but we wanted to make sure that our brands, our suppliers had settled into the BIS supply chain, which is all new to a lot of people. Now that that's behind us, we will continue to open a few more stores this year. And as we overcome the BIS issues and the factories get certified and or up to speed, we should continue to see that Foot Locker acceleration into the next calendar year as well. On the Fila front, I'm very relieved finally that we have gotten out of cleaning up all the inventory for Fila, and we hope to start the journey of opening stores for Fila later on this year.
Okay, all right.
So in just in terms of break-even timelines, the losses have been coming down. What about break-even and overall contribution from Fila? Can you give us some sense of what you are expecting this year?
Sure. Yeah, it's not a question of contribution, because what we've always said was we're going to take the first couple of years to clean up the brand, number one. Number two, the second phase, which we're in right now, is to reposition the brand. So when you move to repositioning a brand, it is not about a percent of sales. It's about, are you pulling the right levers? Are the right assortments coming into stores? Are they selling well? And we've started launching Fila into our Metro and Mochi stores, and we're starting to see the green shoots come there as we anticipated on the year where we reset the brand, right? So that's going on track. And now we also, the next phase would be to start accelerating the opening of stores, and then also accelerating the amount of Fila that we carry in our Metro Mochi stores as well.
Okay, all right. Just a quick question with regard to Fila, Foot Locker, as well as New Era. How much should they contribute as a percentage of your revenue mix? And say in the next 3 years, how much should they contribute?
Yeah, so I think today that contribution is extremely low, right? It'll be single digits. I think you will see that accelerate simply because it's on a low base. From a growth standpoint, it'll be significant, but it's not like we're not growing our other banners as well, right? So we are growing Metro, Mochi, Crocs, and Walkway. We're growing all the banners. So it's not that it's going to jump up and become a double-digit contributor overnight, not because it would have been underperforming in our mix. It's just that the rest of the mix is not stagnant either.
Okay, all right. So a smaller contribution as of now. But, there's that buyout talk by Dick's Sporting Goods of Foot Locker. Does it change things for you?
It really does not change anything for us in our arrangement and our commitment to growing the Foot Locker brand in India.
Got it. All right. So that's out of the way. And what about Fila? You didn't give us a definitive time by which when it turns around. Most of the inventory has got done, that we're sitting on in the third quarter itself. So when does that turn profitable?
It's not a question of timing it on turning around, Nigel. This is the year we reposition the brand, right? So it's a journey. It's not a milestone that you accomplish and say, okay, now we're done. It's a journey. It's going to be a constant journey to build that brand. It'll accelerate as we go through this year, and it'll pick up its own momentum at the pace that we anticipate it to.
Okay, if you could tell us, because you're promising more store rollouts now, both Foot Locker, Fila, etc. I just want to understand how much money you'll need to put to work as you open more of these stores.
Yeah, so the capex is not cheap, as you know, but the good news is, fortunately for us, we have a significant war chest when it comes to cash at hand and cash to invest in growing our business. So that is not the concern. We're more concerned about getting the right locations that sets up the brand to be successful in India at the right metrics financially to ensure that it's not dilutive.
No, we just need to understand, absolutely, sir. Full confidence in your capabilities and your team's capabilities. Just need to understand that from your cash, what is the total cash level right now? How much is going to be deployed towards these store openings? And then perhaps subsequent quarters, we'll talk about the break-even timelines for those new stores. But just some sense.
Yeah, so, we have a sizable war chest. The number changes every day, but it is in the hundreds of crores that we have at cash at bank. So that's not the issue. And as far as it being a significant dent to that, it's not going to be a significant dent to that, as you can do. A store would take anywhere between 2 to 3 crores to open up between the fit outs and the inventory costs. So, it's not a significant factor that we say, what's it going to do to our cash at bank? And, we continue to generate free cash flow as we go through every quarter.
But how many stores will you open this year? We didn't get that number.
No, and it's because, we're not fixated on opening the number of stores. What we're really fixated on is opening the right stores at the right prices. So we'll open as many stores as we can find in the country with the real estate. As you know, the real estate rents have been rising. So now
I think last year you opened 70. This year, will it be as many, fewer, or more?
It should be more.
It should be more. Got it. At least we got some color on that. And final question, ad spends as a percentage of sales, what is it at? And since you're going to be driving growth, where does this number head to?
Yeah, so right now it runs about 3 to 4% in our company. And I think that's a very good question, because I think the time has come for us to take a look at that and see how do we invest in the marketing, in the ad spends, to ensure that we continue to solidify our existing brands and also build the brands that we've recently acquired.
Just last question, Mr. Joseph. These 3 brands which my colleagues were asking about, these shoes are made where? They're made in India? They're made outside India?
It's a mixture of where they're produced. So if they're produced outside of India, they're produced at BIS certified factories. But a majority of that is being produced locally now.
More than 50% of these are being made here locally in India.
50% of Fila and Foot Locker combined, yes.
Got it. Thank you very much for joining us. Good speaking with you, and good luck with your business as we look ahead. Thanks very much. That's Metro Brands. Stocks up about 3% or so. Now, PI Industries also reported numbers. Well-watched company, has been a long-term wealth generator. Fourth quarter, though, was a little tough. And more importantly, the guidance has been a little muted as well. We have Mr. Mayank Singhal, Vice Chairman and Managing Director at the company, now joining us on the phone line. Mayank, good morning. Great to have you with us here. Prashant, this side. Could you, I just want to start with that conservative guidance for FY26, single-digit revenue growth guidance. Could you give us the construct behind that guidance? What are you seeing out there in the market across your segments?
Yeah, good morning. Thank you for having me. I think just if you look at the industry over the last couple of years, the overall AgChem industry has been on a negative growth rate. If you look at all the large big companies, including last year, the top 20 companies all were in the negative. PI was the only company in the top 20 companies which had a double-digit 19% odd growth. So if you look, PI is already starting at a high base, followed with this year where industry was to see a certain turnaround. But once again, there have been strong headwinds, both coming from the agroclimatical situations and crop pricing, and now certain other issues around tariff. Given that scenario, we do believe that the coming year, again, the industry overall is not looking to grow aggressively, but we definitely see positive shoots coming out in the H2 part of the year. So if you look at PI, we have taken that guidance based on the high base, based on the continued 2 years of challenges the industry has seen and is expected to see going forward. But if things turn better, we expect it to better.
No, absolutely, and maybe it'll come through the push, perhaps the revival, etc., comes in the second half, as you said. But if it does not, is it possible, Mr. Singhal, that we actually see flattish growth, no growth, even slightly lower growth compared to what you've done in 25?
Well, let me be honest, it's too early to comment on that, because at the end of the day, industry dynamics do have an important role, specifically if you're playing at a scale and size that we are as a part of the industry value chain. Yeah.
So it's possible. It depends, right?
It's possible. It could be possible on the positive side, it could be possible on the negative side, to be very honest, right?
What about margins, Mr. Singhal, if you can give us a sense?
As you would see, we've already given a guidance for margins, and we would continue to be able to manage the margins that we put that out, given looking at the dynamics of the industry.
Okay. All right. Hi, Mr. Singhal. Good morning. Good to see you. Nigel on this side. One bright spot last year was new products, and the contribution, I think, went to high teens. How much can it contribute to the overall agrochemical CSM exports? Last year, I think it grew on a lower base by close to around 30%. So for this year, what are you factoring in?
Well, looking at that, we continue to further and continue to grow that at the same pace rate. And obviously, as you know, the new products as they come in, they have their own time cycle of ramping up. And if the industry cycles pick up, they tend to ramp up faster, so that ratios could change for the better.
Okay, all right. So that number then could head if it's going to be growing at a faster pace than the overall business. So, the new products could contribute close to around 20%, say, in the next 2 years?
Yes, that's what we anticipate, somewhere around there.
All right, great. Let's talk about the smaller part of your business then, the pharma revenue. That's perked up to around, I think, 85 crores or thereabouts. It's not making too much of money. For the year, I think you did close to around 220 crores of revenues from the pharma business. For this year, what kind of a number are you working with in terms of a growth?
If we look at the pharma business, as you know, we've acquired these couple of assets and capabilities. And as you would have seen, we've acquired a great leadership team, which we're building up across the world. Given the biotech environment and looking at where we stand, we are expecting that this could be the year where we start seeing some green shoots. We've been able to acquire some interesting customer bases, and I'm sure, been confident that we'll be able to give a good growth rate for this business, at least in the 30 plus 40% areas.
I think the growth for the pharma business is much more, right? For this year in the near term?
Yes. Yes.
F26, you're guiding for a 75% growth?
Yeah, that's right.
And at what revenue scales then will this start turning profitable? Because back on the envelope suggests that for this year, you'll be closer to around 400 crores, maybe 370 crores or thereabouts. At what revenue number does it turn profitable?
We believe in the next couple of years, it will start showing positivity, and that's where we are.
Ballpark 500 crores?
Yeah.
Does it turn profitable?
Yeah, that's right.
Mr. Singhal, in pharma, do you expect a significant improvement in margins going forward?
Well, there are two parts of the pharma business right now. Yes, if you look at the contribution margins are pretty good and will improve there, but at the same time, we are investing heavily in building capabilities and resources to scale this up. So, it's a hockey stick issue right now. In the beginning, as P has always done, in the past, if you look at a contract manufacturing business, 8-10 years, we've constantly been investing. And when scale hits, then we are able to actually take that aggressive growth rate. So for that, the front-end investment in system, process, people, infrastructure is what's going to be putting that challenge for now in the short term. But I'm pretty confident in the next 2-3 years, you will see that effect coming up.
But the focus is going to be contract research, contract research, development, manufacturing. I mean, that's essentially the thrust of the pharma business from here on?
Well, it's a part of the CRDMO play. It's just not the contract research and manufacturing, which is in the pharma world, yeah. But where we are leveraging our strong capability in science and chemistry and scientific knowledge.
What about biologicals, Mr. Singhal, if you can give us a sense of, I think that's about 20-odd% of your revenues in FY 25. Again, here you're expecting better growth going forward.
Biological has been always a passion, is a part of our purpose, of putting a reimagining healthy planet. And as we believe today, going further in the ag space, agrochemicals and biologicals are going to go hand in hand. We've been not in biologicals as of today, but we've been doing biologicals over 25 years. We believe we'll be the leading company in biologicals in India in the very near future. As a part of this strategy, our passion for biologicals, we recently, as you know well, last year acquired Plant Healthcare. Plant Healthcare has got a unique platform technology based on which we are looking to take biologicals to the world, with having setups and distribution partnerships across the world in the US, Mexico, Brazil, and certainly in Europe, and further expanding that back and bringing these products and innovations into India. So we do believe biological is going to be one of our front runners, and we expect to see good growth coming from it. As you would have seen over the last 3 years, we've put our focuses on it in India. We've been doing more than a 25% plus CAGR growth, and continued on this pace, if not more, at a global rate, we would be able to put a differentiated capability in the biologicals at a world platform.
Any inorganic growth we should brace for this year?
Well, as you know, the balance sheet of the company is strong. We're sitting with surplus cash. Anything that is complementary, given the environment and the areas of our focus, and can create scientific and scalability and leveraging our existing capabilities would be, which are opportunities we're constantly evaluating.
So you're on the prowl?
Always looking. Nothing wrong with that.
Should we hear about something in this fiscal since you're looking?
Well, I don't know whether I can say that, but I'm always looking for the fiscal or whether there's what. But we will always look for what is right.
All right, Mr. Singhal, good speaking to you. Thanks a lot for joining in. Looking forward to chatting up with you more often. Well, for the time being, we'll slip into a short break. But on the other side, we have Sanjay Swarup of Concord, who's waiting to detail their quarter four numbers. Welcome back. Well, markets are booming away as we speak. We're at the high point of the day. Big moves is what we are seeing, in the markets, and the broader markets as well have seen a good recovery. And I'll tell you what, one positive today is, as I highlighted earlier, we would like to make a higher high. And that seems to be the case today. The last few trading sessions, we've been making lower highs. So that's one positive on the Nifty itself. But as promised, Container Corporation of India, that's the stock on our radar. They've reported actually a very muted performance. Even the past year's performance was rather muted. To discuss what went on, what's the way ahead, we're joined by Mr. Sanjay Swarup, the chairman and the MD at Concord. Hi, Mr. Swarup. Good morning and good to see you in, sir. First, let's focus on volumes. Could you give us the realistic EXIM as well as domestic volume growth target that you have for FY26? I ask you this in the backdrop that last year, well, you're guided for high teens. You ended up with high single digits. So realistically, what can you guide for this year?
Yeah, good morning. Actually, we are having a very good demand in this financial year. We see very stable volumes in EXIM, imports as well as exports. And similarly in domestic also, there is a very good demand, and especially in bulk cement, and then rice is there. And tiles traffic, we are having a very good demand. And apart from that, food grains are also there in domestic. So we have worked out the forecast for this year, and I will like to give a guidance of 10% growth in EXIM and 20% growth in domestic. That will be total growth of 13% for overall for the company. And this is a very robust demand. And seeing all these demands and how to meet with these demands, we have embarked on a very good capex also for this financial year. Last year we have spent rupees 810 crores on capex. This year we will be spending rupees 860 crores actually on capex, and maybe mid-year we will have a review and we will scale up also.
Okay.
Primarily, this will be used for purchasing of new containers and new container rakes and setting up of new terminals. So we are giving a big infrastructure push for the company.
Got it. Okay. All right. Just focusing on volumes then, sir, what is your market share according to your expectations? And also, the hope was that the DCF connections at Mundra, that would jack up volumes. Why is that not happening?
See, DFC connection to Mundra is definitely giving us good volumes. And now in this financial year, we are expecting that even Nhava Sheva will also be connected on DFC by December 2025. Of course, we will feel the impact only in Q4 of this financial year. And we see a very good volume growth on Nhava Sheva stream also. Mundra, of course, is giving us very good volume growth. And we have been able to divert lot of traffic from road to rail as a result of the timetable trains that we are running from our MMLP at Dadri to Mundra.
Okay. And your market share?
Our market share actually on a pan-India basis, if you see, it will be around 58 to 60%. And one thing I want to add is we have gained the market share without sacrificing our margins. We have been consistently able to maintain EBITDA level of 24 to 25%, which is very good in logistics field because normally in logistics it is in single digit.
All right,
so despite maintaining the EBITDA, yeah, we are able to give increase the market share.
All right, sir. So you'll be able to maintain your margins at these levels, right?
Yes, we will be able to maintain our margins also, and we will increase our market share, as well as I am very sure that we will be able to achieve the guidance of overall 13% growth in this financial year.
Okay, all right. But realizations, they came in at multi-quarter lows in the second half of the year. What is causing this kind of unusual pricing pressure?
No, actually, I will not call it a pricing pressure. It was not a pricing pressure. It was a strategic decision for the company to pick up some traffic volumes. And now we are okay. And if you see the overall EBITDA margins of the company, you will be seeing that for the financial year, we are quite close to 24-25% that we have been there for so many years. So there is no pricing pressure on us. And we are, serving the niche segments, and we have a tie-up with big corporate houses. So there is no pricing pressure on us, frankly speaking. Basically, we get our customers, we get our volumes based on our service levels. We give a lot of emphasis on service levels, and that is appreciated by our customers.
Mr. Swaroop, sir, overall question on this long-awaited completion of the dedicated freight corridor. I think there's some reports indicating that maybe the western arm could be completed ahead of schedule. Maybe we see some traction in October. Just give us your estimates on how much of a boost will railway get once the DFC is fully operational, and more importantly for you, can you give us some sense of volumes, the implications for your business if the western arm, at least of the DFC, gets commissioned ahead of schedule in October this year?
See, officially, we have been told that Western DFC will be commissioned up to Nhava Sheva. That will be completed by December 2025. So I have been reading some media reports that it may be completed ahead of schedule, but that will be a welcome sign for us. And we are fully geared up. We already have our 4 depots on Western DFC. 5th one is coming up near Ahmedabad. So all in all, we will have 5 depots on Western DFC, and we are fully prepared to cater to the increased traffic that we are expecting in Western DFC. If to answer the second part of your question, when the Western DFC is commissioned, we cannot expect that overnight there will be a spurt in traffic. It will take at least 1.5 years to stabilize, and I am pretty sure that the rail coefficient at JNPT, which is at present below 20%, within a span of 1.5 years of commissioning of Western DFC, it will double.
So, sir, okay, I mean, give or take, whether it's October commissioning or December, we'll see. But give us some sense of projections. I mean, how will your volumes change in calendar year 26? Or let's say FY27 would be perhaps a better measure. Once the Western DFC stabilizes, as you're saying, what's a numerical implication that your investors can look forward to?
See, this year I'm giving guidance of 10% in growth in EXIM. Maybe next year, if I give guidance for FY27, maybe this 10% may become some in the range of 17 to 18%. That is the rough estimate I can give you.
Okay. All right, Mr. Swaroop, a couple of more factors that I want to clear out. What is the LLF that is expected in FY26? And what's the status with regard to the disputes with Indian Railways?
I would like to clarify, there is absolutely no dispute with Indian Railways. It is our administrative ministry. We are working under Indian Railways. There is absolutely no dispute at all. Okay. And secondly, as far as the LLF is concerned, it is fully sorted out, and whatever LLF we have been paying every year, it will be around same level, because there is growth of LLF by 7% every year as per the formula. But at the same time, the land which we are not using, we are surrendering back to railways. So we will be maintaining around the same level. LLF number will be around the same level.
Okay, all right. Final question. We cannot let you go without asking you this. Since you're guiding for better times ahead, Mr. Swaroop, is a divestment on the corner? Because that was a big trigger from a stock market perspective.
I cannot answer the...
Have you heard about anything, sir? Any communication has come?
That is a policy of Government of India, and whatever directives we get, we have to follow that. I can only tell you this much.
Okay. All right, Mr. Swaroop, we'll leave it on that note. Thank you very much for joining us and giving us a sense on how the business is progressing. FY26 should be better than 25, and 27 maybe even better once the western arm of the dedicated freight corridor is commissioned. Well, that's Concor. Back to the markets, and markets are cruising along nice and steady, almost a 200-point rally on the Nifty. So it's turning out to be a really good Friday morning. There we go. And lots of mid-caps also bouncing around 0.5% up on the mid-cap index. Let's put the spotlight on some news. Ekta is tracking Sun Pharma. While the market's doing really well, it's not been such a great morning for Sun Pharma because of the fourth quarter performance and the commentary going forward. Ekta, tell us why is the market a little disenchanted with Sun this time?
Well, yes, definitely. It's besides the numbers, that's what the street is disenchanted with. So, for example, they are looking to invest $100 million in terms of additional costs on their specialty products. Plus, their R&D expenditure is going to go up to around 6 to 8% of sales. The FY26 guidance is around mid to high single-digit top-line consolidated growth. This is versus earlier years of around high to low double-digit growth that they've generally guided for, high single-digit to low double-digit growth. And they have mentioned that it is because of the uncertain environment that they're facing on the regulatory front, on tariffs. So as of now, they don't have clarity. Besides that, no EBITDA guidance which has come through. So there is uncertainty which is, on all fronts except for especially for the guidance. Now, if you look at the geographies as well, US sales $464 million, Street was anticipating over $500 million. Global specialty sales in Q4 were $291 million. There were some estimates of over $300 million, $310, $315 million. So that's the reason why there is some amount of disappointment which has taken place in terms of the numbers. Otherwise, in terms of the operational performance, it was an in-line quarter for Sun Pharma.
Okay, all right. Thanks very much for that, Ekta. So that explains the negative 3% move on Sun today. But back to stocks that are on winning ways, and Power Mech is definitely one of them. Stock's been up almost 12, 13%. Yeah, 12% right now, as we're seeing it. This on the back of what looks like a very solid fourth quarter. Vivek is back. Vivek, remind us about the numbers and the performance.
Well, that's right. What we have to keep in mind is as far as most of the infra companies were concerned, remember H1 was very muted in terms of execution. So despite a good order book, a lot of the companies faced significant execution challenges on account of lack of labor as well as the election-related disruption. But what's actually transpired is that most of the infra companies, as far as H2 is concerned, especially in Q4, have managed to end the year on a very strong note, especially when it comes to execution. So when it comes to Power Mech projects, look at the numbers. Revenues in this particular quarter higher by 42.5% on a year-on-year basis, a little over the 1,850 crore mark. The EBITDA higher by over 44.2%. Cost of materials, despite going higher, has been more than offset by the operational efficiencies that the company has shown. EBITDA margins on a year-on-year basis up 10 basis points. That should be seen quite positively, and profitability higher by over 52%. On a year-on-year basis, again, profitability higher by 42%. Remember, the company is sitting on a very strong order book as well. One portion of the order book, remember, is from the MDO, which is the Mining Development Operating License as well that the company enjoys. So overall, it'll be interesting to see. We're still awaiting the investor presentation, but the order prospect pipeline as well as the order book at the end of Q4 is something that the street to watch out for. Overall, a good operational performance is leading to the stock up move.
Almost at a new high. After the short dip that we saw recently, Power Mesh there. Vivek, thank you very much for that. 200 points now on the Nifty. And, this is the expiry got done yesterday. There are two things. One, of course, is the expiry itself. So that Thursday expiry, we've seen big swings, market yanked up, yanked down. Yesterday was down. It's a bit of a cleaner run. The second is this is also the week before the monthly expiry, which is next week. And, the week before usually typically tends to be a little subdued. There is also some correction, etc. At least that's been history. And then the market finds a bit of a trend the original trend, which has been on the way up. Is that essentially what is happening? I think one needs to see. But it's very, very strong gains now. So 24,800 is back on the table after yesterday, intraday, the market breaking the 20-day moving average. So this is looking very good. We have Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, now joining us. Vinay, good to have you here. Thank you for your time. So what's the trade here, if any, on the indices and then specific stocks?
Yeah, good morning. So Nifty found support at 20 days EMA. Yesterday we saw a nice recovery from the lower level post 2 p.m. and today it is continuing today almost 200 points rise in the Nifty from the lower level. So a nice recovery, nice sector rotation is going on. I think the bias is positive. However, 25,000 is a very strong resistance. So overall we are into the range of 24,500 to 25,000 range. So till that range holds, we can say that markets are into consolidation, but the primary trend is clearly positive. Once we see Nifty crossing 25,000 on the upside, then immediately we can see 400, 500 points upside. So stock specific, sector specific, there are many opportunities that one should trade. Nifty, no doubt today it has already registered a recovery of 200 points, but one should look at the stocks rather than Nifty index. So IT is the index which looks very promising to me. So after consolidation, it has given fresh breakout. So there are opportunities in the IT stocks. One can concentrate and generate some alpha in the trading.
Any specific names here?
Yeah, so Coforge is one of the stock which we like from the IT space. It is one of the strongest stock from the IT space. So Coforge can be bought around 8445. Stop loss can be kept at 8300. On the upside, I'm expecting a target of 8650 in next couple of sessions. The second sector which we like is the real estate space. So Oberoi Realty has just surpassed the crucial resistances and looks very promising on the charts. So Oberoi Realty can be bought at 1735. I would suggest a trading stop loss at 1700. On the upside, I'm expecting a target of 1790 in next couple of sessions. So Oberoi Realty and Coforge would be my trading bets.
Okay, all right, got that. Vinay, thank you very much for being with us. So those are some of the trading calls of the hour. Let's move on and get you something from the auto space now. It's quite exciting for those who are looking to buy perhaps, a new hatchback. These days, the new hatches are few and far in between in the Indian market. Tata Motors launched the new Altroz hatchback, and this at a price point of 6.89 lakh rupees ex-showroom. This is the first major upgrade that the premium hatch has received since it was launched by the company, Tata Motors that is, in 2020. We caught up with the MD of the company, Shailesh Chandra, who believes that premium hatchbacks will drive growth for Tata Motors in FY26.
The players who had exposure to both SUVs as well as hatches pretty much mimicked the slowdown in the industry. But SUV-heavy players did see the benefit given the growth rate that we were seeing in the SUV segment. Hatches, which declined by 13% in the industry, our decline was more than 30% because of the aging of two products that we have in the hatch segment, which was Tiago, which was also in the fifth year requiring a major intervention, and the Altroz. And we lost nearly 50 to 60,000 numbers as compared to FY24 because of the issue of aging and also the decline of hatches which we were seeing. But we launched the model year, intervention, and a new Tiago was launched in January 2025. And in Q4, we saw a significant jump in Tiago, coming back to the volume levels where it used to be. And now we have Altroz, where we had seen the significant decline, that also coming with a very strong refresh. Our refreshes are going to come in time. So there will be one refresh. You have already seen the new Altroz. There will be one or two more which you can expect in this financial year. Then there is expansion of EV portfolio with Harrier and Sierra also coming in this financial year. Then you would have the ICE portfolio, which will come with a new nameplate, which is again Sierra ICE. So a lot of actions that you are going to see during the year. At an industry level, or if you really see all the consumer-facing industries, there has been a bit of slowdown for last 1.5 years. And we see that trend right now, continuing, and therefore at an industry level, we are seeing pretty much a similar kind of moderate growth as we had seen in FY25. Specifically talking about entry segment and If you really see the hatches segment, which has been declining as far as the share of TIV is concerned, but within the hatch segment, if you really sub-segment the hatches into 4 parts, entry, mid, high, and premium, there's a gravitation towards the premium hatchback segment, and it is coming at the cost of significant decline in the entry hatch segment.
Okay, well, we'll take a quick commercial break here. Markets up 200 points on the Nifty. Lots of stock-specific action. Manisha will be with us with commodities in focus on the other side. Stay tuned.
Welcome back. Let's talk commodities now. Equities are, of course, having a good morning. We've got Manisha joining in to talk about the big headlines and the big cues. Manisha, so what's the main headline this Friday morning?
Well, I'm looking at natural gas prices, and that is because we've seen a very sharp correction onto this one. Remember, the first quarter of this year, the natural gas prices were just rising higher, and markets were looking at various kind of tariff impact on this. But overnight, we've seen natural gas prices decline by 3%. It's down 2% in a week. It's down 10% in 2025 till time. But when you look at the last 12 months, we still are trading in the positive, up by nearly 18% there. Well, also, when you look at the overall markets, it is about increase in supplies in the recent few months there. The markets have seen a strong build-up when it comes to US in sense of inventories there. So if you look at the build-up right now, it's at 120 billion cubic feet. 1-year average has been at 78 and a 5-year average at 87. So we are looking at inventories much higher than what has been a high long-year average as well. So with this kind of a build-up, the total gas storage that stands in US right now is 3.9% higher than a 5-year average, which stands at around 2.3 trillion cubic feet right now. Also, when you look at the LNG exports, well, for the month of May and April, we've seen those numbers continue to gain up on the higher side. It was 16 billion cubic feet in the month of April, and May is looking at 15.1. So that in turn also seems to be weighing onto the markets. US LNG output, well, if you look at that, has been a record in the month of April. It is also a low demand season. But going forward, the street anticipates that you could be looking at demand coming back, especially as we are getting into Atlantic hurricane season. And then most of the countries will start increasing inventories ahead of that winter period season as well. So that could be supportive. This quarter, markets anticipate you could be looking at some more pressure coming in. Going forward, it also is about a future perfect because you are looking at natural gas demand very strongly coming in from artificial intelligence. It's projected that the demand will increase for powering data centers, which is 24/7. And that is, especially when it comes to US and Canada, European Union, natural gas is what is used for AI data centers. Global natural gas demand could surge by 50% by the end of decade is the view coming in from Australia Woodside Energy. They are the biggest when it comes to natural gas in Australia. Strong statements also coming in from IEA, which says that the AI-driven data centers will increase electricity consumption by 90 trillion watt hours, and much of this would come in from natural gas. So near term, well, cyclical bearishness, but structural bullishness could continue for natural gas prices.
All right, Manisha, thank you very much for that. So that's the commodity view. We'll take a quick commercial break here. We're going to put our focus on energy, renewable energy, and we'll talk about the challenges that the sector is facing, if any. The broad global kind of push, of course, has been that thermal is back, coal is back, or at least it wants to be. In that context, what are renewable efforts here in India looking like? Lots of listed options here as well. So we'll have Mr. Mohit Bhargava, former CEO of NTPC Green, Sumit Kishore of Axis Capital, talk to us about this. Stay tuned.
Welcome back. We're putting the spotlight on the power space, specifically India's drive to move towards non-fossil fuel sources of power, the whole renewable push. Mohit Bhargava, who is a senior advisor at the University of California, Berkeley, and of course, he's also been the former CEO of NTPC Green. He's with us, and we have Sumit Kishore, Executive Director at Axis Capital, to talk more about this. Gentlemen, thank you very much for joining in. If I could actually start with you, Mr. Bhargava. Now, our ambitious, dream of reaching 500 gigawatts of capacity on the renewable side, I think last count, some notes that I read, by the end of 2024, we were roughly at about 209, 210 gigawatts. Some argue that the pace of movement is slow. What are the major challenges? I mean, I was reading somewhere that apparently 40 gigawatts of capacity is stalled because PPAs are not getting signed quickly enough. What is your assessment of how quickly we are moving towards this 500 gigawatts target, and what are the major issues, if any?
So good morning, and thank you for having me. Yes, we can always say that the speed is probably not at that level at which we are expecting to achieve our overall objective of 500 gigawatts by 2030. Uh, and yes, there are multiple challenges, and probably this is being discussed. This has been discussed at multiple levels. I could probably list down a few. Among them, of course, are land acquisition challenges. There are challenges with transmission evacuation. There are challenges with execution in terms of getting the PPAs off the ground, as you mentioned. So these are all challenges which are there. And in fact, there have been a lot of focus also, if I may say so, in terms of what's the support being provided. Because I think there's also one report which says that the government is actually again pushing the coal-based power. So it's also whether the question whether the government has kind of taken the foot off the pedal for renewables. I don't think so, but yes, those are all challenges which are there.
Is there a threat that we'll miss this target, 500 gigawatts by 2030? I mean, I don't get the sense, hearing you, that there's too much of an urgency that something needs to be done. I mean, if you just put it in perspective for us, are we moving along at a fine pace?
I would say we are moving along at a fine pace, but there's always room for improvement. And 500 gigawatts, I must say, you see, that's a very good ambition to have. I am quite hopeful that we'll be ending up very close to that. But obviously, there are challenges. I mean, look, for example, transmission probably today is one of the biggest challenges because the pace at which the evacuation system is working is probably not in line with what the renewable energy producers want it to happen. And one of the reasons why, if you check with the CTU website, you'll find that there's a long queue for connection. And the earliest now apparently available is around 2029. So a lot of activity which is happening is also incumbent upon the fact that transmission needs to be pushed further quickly. Of course, there's also on the other side, even the capacity which is already operational. I understand there are challenges in actually pumping the entire power because there are probably some segments of the transmission system which are not up and running. So for example, if there's a 1,000 megawatt renewable project, it probably does not get fully scheduled for 1,000 megawatts also at various times during the day. So these are all challenges, and we need to move quickly on transmission.
Got that. There are questions whether the government has taken its foot off the pedal, but you don't think that is correct. We have Sumit Kishore also with us. Sumit, good to speak with you after a while. Yes. You want to reflect on some of what Mr. Bhargav said and your thoughts on this?
Yeah. Good morning, Prashant. I think to add to Mr. Bhargav, despite the on-ground challenges, India has added almost 33 gigawatt of capacity in FY25, an increase of almost 28% on a year-on-year basis. So if you think about it, 33 gigawatt is the highest capacity addition in a fiscal ever. The next highest was 30 gigawatt in FY16, which was at the peak of the thermal capacity additions in the last cycle. So out of 33 gigawatt, almost 24 gigawatt was solar, 4.3 gigawatt was wind. So it has been a decent outcome. What actually happened last fiscal was that the peak demand grew just 2.7%, which was quite weak. And post-COVID, you had the weakest power demand growth in the country of just about 4.2%. So weak power demand and declining battery and solar module prices have allowed DISCOMs more time to finalize their power procurement plans, as a result of which you see a large pile-up of renewable letter of awards of over 40 gigawatt where PPAs have not been signed. I think this fiscal, again, so far, April power demand was just 2.2%. May power demand is down 2% year on year so far, and peak demand is at 231 gigawatt so far in May. And end of May last year, it was 250 gigawatt. So you're in a summer season where peak demand is actually down on a year-on-year basis. So I think more than the execution challenges have been evergreen. They will remain. But I think over the next 2-3 years, what is very important is that power demand growth, if it revives itself, you would basically find everything else falling in place. In FY26, the worst risk is that there is almost 8 gigawatt plus of coal capacity addition that could come on stream, even if there are 6-month delays versus CEA target. So, if that is accompanied with weak power demand and strong RE capacity addition, DISCOMs will be able to wait even more to sign PPAs.
I get that. Sumit, for the listed universe here, for your Varis and Premier and, what does this environment mean? Because then this will keep piling up. And there is a fair bit of demand, which is additional demand for, solar modules, etc., which is coming up. And for these two companies specifically, this is basically there is strong demand, very strong demand for maybe 2 years. But then after that, what? Because there is a lot of capacity which is coming up. So just your thoughts here.
India's power demand is a secular growth story. In the last 15 years, India's power demand grew at a CAGR of 5%. Possibly it can grow faster in the next 5 years because you have new levers of power demand growth like data centers, EV charging, green hydrogen. So I think there is a long runway of capacity addition that India can sustain. Think about it. Simple math is India had a 250 gigawatt peak demand last fiscal. If you have 6% power demand growth, that's 15 gigawatt. If you have to meet that using wind, solar, where the PLF profiles are lower, and even with a bit of thermal, you still have 40% say average PLF. So 15 divided by 0.4 is 37.5 gigawatt of capacity addition just to keep pace with the demand growth in the country. And that will keep growing every year. So there is a long runway. Let us not be very skeptic.
No, not at all. In fact, I was just looking at the trends, I think, out of April, that while overall demand was soft, this evening deficit issue always leads to spikes, right? And I believe on the exchange on IEX, prices were touching almost 10 rupees per unit, just to meet that short-term evening, demand deficit. Sumit, from the listed stocks point of view, and I'm not asking short-term, 1 or 2 months or 3 quarters, but if someone is to play the renewable theme from a portfolio perspective, then how would you advise them to do it? Would an integrated player like Tata, which is giving you both traditional as well as renewable, would that be the way to go? Power exchanges, stocks like Power Grid, etc. What do you play in the power supply chain?
Almost across the board in power sector, we have seen over the last few years that the pace of capital expenditure has gone up meaningfully, led by green growth. And even aspirations for companies 5-6 years out have a meaningful compounding in EBITDA led by green growth aspirations. So companies which are able to sign PPAs and have decent visibility on earnings compounding, EBITDA compounding over next 2 to 3 years stand out. So in that bracket, you have companies like JSW Energy, which have seen a healthy dose of both organic and inorganic growth, and even Tata Power, which has a more integrated approach to not just IPP capacity addition, but solar equipment manufacturing and solar EPC, which is seeing decent growth. There is possibly the privatization of DISCOMs in UP, which is standing out as a big catalyst for companies in the sector, in the distribution space, including Tata Power, Torrent Power, CESC, and so on. So I think all in all, even exchanges are having a party right now because in the advent of weak power demand growth, there is a lot of coal availability. International coal prices are flattish, and you see that exchange prices, even though they are spiking in the evening, on a year-on-year basis, exchange prices are down 15-20% year-on-year, which is welcoming the DISCOMs to come to exchanges, welcoming C&I customers to go to exchanges to optimize their power cost. So which basically means that exchanges saw earnings growth of 20% plus in the last financial year, and even so far this quarter, volume growth has been quite strong despite power demand growth being weak in India. So I think this is a secular story where India will follow Europe and other developed markets, where over a period of time, penetration of short-term power supply in India will keep going up. 10 years back, we were at 3-4%. We are at 9% plus of total power supply in the country, which is being transacted on exchanges today. I think this will go up to 15-20% in the next few years.
Sumit, you said don't be too skeptical. In stock markets, always be skeptical.
Yes.
Even for the best laid stories. I think that's got to be the motto.
It was more from, operational and,
Yeah, I get that. My question, though, was only about Waaree and Premier and, solar modules. It was not about the overall, how much will power demand grow, and you said those numbers, etc., all make sense. But my question was about these two. I mean, will there be overcapacity, which you yourself provided the context for?
No, so that's a separate question on the solar equipment manufacturers. I think India already has excess capacity for solar module assembly. We have crossed 70 gigawatt in terms of annual manufacturing capacity for